just basically means we're trying to own $1 billion worth of real estate, right? Which is a big, lofty goal. But in order to achieve that, and this is number 2, we both have to be absolutely absorbed in the truth.
Yep.
And everything has to be always on the table. That's why when we're talking to our team, when we're talking to each other, talking to investors, we lay everything out on the table. If you like.
What's going on, guys? Welcome back to the Members Room. And on today's episode, we have Jaynish and Tedi with JT Acquisitions. Great episode we just had. Hope you guys enjoy it. On this episode, we talk about real estate investing, property management, and the good and the bad that comes with it. Hope you enjoy, and we'll get right to it. Well, guys, thanks for coming on.
Thank you for having us on.
Of course.
We got Jaynish and Tedi of JT Acquisitions.
There we go.
Yes, sir.
Great new up-and-coming young real estate company, real estate syndication company. Do you guys want to explain what a real estate syndication company is?
Sure. So essentially, it's the pooling of capital, like investor capital, right? So somebody invests in us. They say, hey, we have XYZ real estate deal, call it a 20 unit. Somebody goes, oh, I want to invest $50,000, and in return, I'm going to get capital back, or I'm going to get all the return proceeds from the deal. So that's a combination of cash flow, right? So we send out cash flow on a quarterly basis, and then when we also sell the deal, then you'll get the returns based off the increase in value of the project, right? Jay, you might want to add a little bit.
I mean, in a simple term, syndication can be applied across anything. I mean, if you want to buy a car wash, you want to start a restaurant, it's just a way of organizing and structuring legally with securities a business. So if Alex is really good at restaurants, and I don't know anything about restaurants, but I like Alex, I like his restaurants, I want to be a part of it, I could give him money. And if it's not a publicly traded firm, it's a private transaction of securities being exchanged. There's a process in which you have to document it legally. You have to classify Class A members and Class B members, the operational members, and then the passive members. And then it all gets doctrinated in something called a subscription agreement and a private placement memorandum. I don't want to get too technical here, but they're just the two documents that basically explain the relationship and the organization of the hierarchies of the structure, and it makes it very easy for you to retain the relationship, and everything that you agreed on is right there in Lehman terms. So it's finalized and it gets filed with the securities attorney and it gets reconciled with the IRS, and it's a simple way of just keeping things going and privatized, which is the most important part. But in a small a simple way of talking about it, it's I want to get this business done. Who's managing it? Who's investing in it? And that gets separated. And one pool is where the investors invest their money. The other group is operating it. And that's pretty much it.
And to add one more piece, it's like there's GPs and LPs, right? So GP is a general partner, which is essentially the managers of the deal. These are the people that are entrusted to secure the business plan and execute the business plan.
Full control, by the way.
Full control.
Yeah.
And then as a limited partner, hence the word limited, they relinquish their right to manage the deal, right? And so they give their right to the GP, but in return, of course, they're going to get capital back.
Before you continue, I think I'm really happy you said that. And to a person listening, they'll maybe like, relinquish my rights. Like, what the heck? It's like, no, like, that's what makes this so beautiful as a privatized investment. You want that. You're not the expert of this operation. You're not the expert of whatever vehicle you're investing in. You're deferring that to the trust of the partnership. And that's what's beautiful. Both parties agree. It's like a relationship. You both agree on what you're doing, you know?
It's a little marriage.
Yeah.
Definitely. And I definitely want to get more into that later. To start, let's talk about your backgrounds. Were you guys into real estate at a young age, or did you guys kind of just like fall into it at some point? If you guys want to get into that.
It's kind of interesting. I had a full circle moment as soon as we started getting into real estate, because my dad was in real estate in Albania. That's how he kind of made his initial money, right? And then, so to go backwards, I'd say 3.5 years around this point, right?
Yeah.
Talk a little bit about the acquisition story, or what's the right word I'm looking for?
Conception.
The conception.
There you go. That's why he's the host. That's why he's the host.
There you go. So I had met Jaynish at ABT. We were both in college at the time. Apt is the electronics store over in Glenview, right? Shout out Apt. And we were both in the electronic service department. At the time, I was managing some stocks for people. It was like, just a small amount, like 100,000 or so, right? And then Jay at the time, he goes, Jay at the time, he goes, I'm trying to, raise capital to buy these real estate, like larger real estate deals, multifamily. I'm like, man, you're batshit crazy. Like, there's no way you're going to be doing this at like 21, 22 years old, however you were at the time, right? But me being very hard-headed and him being very persistent got through my thick skull, like, let's do this. And so essentially at that point in time, I kind of gave up my original dream of starting to manage money in stocks, right? I had this conception of like a hedge fund, you know, money management, whether you want to call it like a real estate. I mean,
That's a cool dream.
It is a cool dream, yeah. So I wanted to be some sort of like financial advisor, right? And I was actually studying for my tests. I actually didn't like studying for the tests. I hated all the boundaries and barriers of
The Series 7, right?
The series, 6, 7, 63, so on and so forth. And so, I mean, Jay and I, the way that our personalities work, it was so hand in hand. We have the same morals, have the same principles. And so eventually I was bought in. I'm like, let's go, let's start this thing.
Now, did you know anything about real estate investing prior? Or I know you said your dad was in Albania, real estate investing, but did you know the numbers, how to find a property, all this good stuff?
Not necessarily. So I have a finance background through DePaul. I will say this, no hate against DePaul, but the majority of what I learned was all through what we call like YouTube University, right?
Yeah.
YouTube everything, read books, podcasts, so on and so forth. And so I had a conception of what it meant, like, obviously there's income, there's expenses, there's a bottom line,
Like
cash
back of the
flow.
napkin, you know?
Yeah, back of the napkin,
Yeah.
and then returns and all that. So I knew I had a general idea and a strong foundation for learning.
His
right?
dad is very old school, and it's funny to say I'm more like his dad, where it's like he gets his sophistication from his dad, but like if we're analyzing a deal, Teddy will break it down fully on the model, whereas like I'm looking like his dad, like let me get the 4 or 5 variables controlling the deal,
Exactly, yeah.
and then if there's enough buffer, but that's what makes our relationship so unique, where it's like I respect that and I value that about him, and like I know that's necessary. But like sometimes in certain cases, I'm thinking too big picture, and he's thinking too ingrained into the details, and that matters at certain points. You know, if we want to progress ourselves, where we feel like we're battling a back and forth, where should we do this or should we not? We're weighing both those sides, and then shout out to Kush, like he'll come in and weigh the context of the situation and really even it out. But those two opinions, those two perspectives, we never try to bash each other for. It's like we value it. And even if it doesn't matter or doesn't contribute to the decision now, we understand why it's respective in the totality of things.
Which is great. You have those two perspectives.
Yeah.
So you can kind of see both ends of the stick and
Yeah.
see, is it better this way or this way?
Yeah.
So you guys can,
It's important, man.
Yeah.
The thing is, the last thing you want is everybody thinking the same way you do, because then you're missing every blind spot possible. And what we really pride ourselves in, and a lot of the people that choose to partner with us or invest with us, is like me and Teddy can be in a business meeting, Teddy and I can be in a business meeting, and we can go we can go back and forth with each other in front of the investor. And if that investor gets turned off on it, great, we don't want to do business with you. But other investors will be like, I like that. This should happen for every decision.
I think we're trying to stay true to ourselves,
Yeah.
right? Like I'm not trying to bend my personality, or Jay's not trying to bend
Yeah.
his personality to XYZ person in front of them, right? Because at the end of the day, I just want to be true and natural, and what comes the easiest path, because I think that's the best way to do business, right?
It's a path to truth, you know?
Exactly. If
And
I'm
that's-
trying to mold myself to become something I'm not, it's gonna
Yeah.
flow right out of me. You're gonna see I'm just being fake, right?
And you're also going to you're going to be distasteful about what you do. You know, like I asked you before we started the podcast, like, why are you doing this? You're like, dude, I just enjoy it. The moment it becomes distasteful, you're not staying in harmony with why you're really doing it. And you're going to feel the little stuff that you didn't notice when you were enduring the little challenges. You start feeling it more. You start getting annoyed by it, and that's when you got to reflect and go back to the drawing board and see what's the catalytic moment that led to this,
I think seeing you two fight, if I were to be an investor, seeing you guys fight over a deal, saying, "Oh, I think we got to worry about this, we got to worry about this," that would actually be great from an investor's eye, because these guys are willing to go to bat for me, for this
But you
investment.
have that perspective. Other people, and that's what I mean. Like a lot of people, you don't really know what other people are trying to perceive themselves as. So just because someone has money doesn't give you an assessment of their risk tolerance, their background of how they look at investments. Are they more conservative in nature? Are they et cetera, et cetera? But the mindset and the principles is what Teddy alluded to is the biggest thing. If you value that mindset and that principle of just having that back and forth, no matter what it is, that's something that's prestigious throughout life, because it doesn't matter what the concept is. It's if you're trying to buy a new car, whatever it is, if you're always weighing in on both sides and having a debate about it, not an argument, a debate about it, where you're looking at both sides, that's a polarizing thing to do. And it gets the best outcome. And at the end of the day, you feel more content and happy with the decision looking back.
You know what's so interesting? Actually, right before this, I was at a coffee shop, maybe like 3-4 hours ago. I randomly got in a conversation with this guy, and we got in a deep philosophical conversation.
Usual.
And I don't know how it happened, but the idea of how we became business partners and what we value came into fruition in the conversation. And one of the things I always said is like, we're just both absolutely in search for the truth, as he had alluded to earlier, right? And I think that's one of the things that I told Jay very early on. I'm like, I am 100% on board so long as 3 factors have to be met, I should say. One, we're trying to reach 1 billion, right? 1 billion assets under management, which for those who don't know, assets under management just basically means we're trying to own $1 billion worth of real estate, right? Which is a big, lofty goal. But in order to achieve that, and this is number 2, we both have to be absolutely absorbed in the truth.
Yep.
And everything has to be always on the table. That's why when we're talking to our team, when we're talking to each other, talking to investors, we lay everything out on the table. If you like what you see, great, let's move forward. If you don't like what you see, let us know. Maybe we'll pivot. Maybe this is not a good relationship for us, right? And then, so that was the second thing. And the third and most final thing, this is kind of the most selfish of the 3. I'll say, I just want to wake up every day and be happy with what I'm doing, with the people that I'm doing it with.
I don't think there's any problem with that, though.
No,
Right?
there isn't, because I think
Yeah.
if I'm fulfilled by that, then I'd hope you're also fulfilled.
For sure.
You're probably searching for the same exact thing, right? Who doesn't want to be happy?
But now that you're talking about truth, it's this is something that we brash over, and now that you're really explaining it, the seek for truth really takes a seek for really understanding who you are internally, and it's constant self-awareness, and it's being truthful with yourself. Like, what am I not good at? Where did I fuck up? Like, where did my bad?
You're good.
Yeah, like, it's being constantly checking yourself, like knowing your flaws, knowing your mistakes, and calling them out. And like the best thing that we do is like, if we ever it's an accountability game. We're the first ones to be like, no, my bad. No, it's like, no, my bad. Like, and we're like fighting for who's taking the blame, and it's like, that's the hardest thing to do. And most people are too stubborn in themselves to do that. And I feel like the precedent that Teddy and I set, because you said, if investors are watching us argue, bro, like our whole team is just watching Teddy and I go back and forth, And if me and Teddy can get personal with each other and be on each other's ass, the whole team can be receptive to that, And that's the whole thing. And we're not doing it to put on a show. It's like the first thing, like Teddy said, this is the goal, you know what I mean? And how locked in are we into that goal? And everything else is the precedence of leadership. And then obviously you can't have a flourishing company without people loving what they do and the people they're doing it with. And that's the most important thing. And I think culture vets that. And that's set by the people at the top.
Exactly. And we set our North Star, so to speak, or set our goal very high. And everybody knows that goal.
Yeah.
So if you set the goal and you constantly reiterate it and always tell the team about it, and sitting in the back of their mind, marinating 24/7. So if it's marinating their mind 24/7, and that's all they think about, then you know that we're all pushing towards that same goal, which then brings us closer as a team.
But one key word that he left out was incentivizing, right? It's not just that we're reaffirming the goal, we're braining it into them. It's the incentives that they have a part of the piece. Like everybody feels like they have a crucial piece of getting to where we want to be, and we let that be known. Like, we delegate this, and this is your job. And when we don't ever try to push you into, hey, are you doing this? Are you doing that? It's, we trust you with this, and your piece matters, and it's properly incentivized in terms of the notoriety you get, but also the equity and the compensation that you get. And those two have to be in fruition to get to where you want to be. You know?
For sure.
Yeah.
And we'll dive more into that. I just want to go back and find out how you started.
Oh yeah.
Which was initially JP Acquisitions, but now JT.
Yeah.
When you guys met at Apt Electronics, what made you have that vision of owning all this real estate? And why'd you approach Teddy?
Yeah. I mean, I believe in God, and I think if you work hard every day, whatever spiritual power you want to believe in, the harder you work, the luckier you're going to get. And that luck is a matter of whatever your faith is. But I mean, honestly, growing up, and it's kind of funny looking at it, like in retrospect, because my dad didn't do this intentionally, but like growing up, like there was always at least 7 to 12 people in my house, and there was a 2-bedroom house. So like, if you got to wake up and you got to leave by 9, you got to go take a shit downstairs and go shower upstairs by whatever time, And it's like, so every day, like the stuff that would piss people off or like would ruin someone's day, it's like I'm already going through so much adversity, which I don't even call adversity anymore because it's routine, and it's just built a thick skull for me, and built, like I just could not be bothered. I don't care what people think, whatever. But on top of that, it was like my dad would always tell me like, hey, I've sacrificed all this for you. I'm putting all my eggs in your basket, and it's your job to get us to where we need to be. And a lot of people would succumb to that. And, I looked at it as like, it was empowering to me. It's like, wow, like this person really, he wasn't believing in me. He was just like, it was more like, you better do this, But I was like, okay, well, if that's the case, let me start looking at vehicles, And obviously my family is Indian, so I was like, okay, let me do this. I'm gonna decide to go become a doctor, the easiest doctor there is, which is an anesthesiologist, just not really much to do with the actual operations of what it is to be in that field, and then start franchising, But as I was going throughout high school, I realized, like, I don't want to be long-winded about this, but there is this app, Tile nowadays, or AirTag, the Apple AirTag. Mm-hmm. We had this one class called Entrepreneurship my sophomore year, and that whole year, the entire year, you're just creating a business plan, which you'd pitch to investors. And I thought of this idea where it's like, in your credit card, there's an RFID chip. Mm-hmm. I thought, you can make this camouflage, and you can put it on anything where it's not noticeable, because if you have something obvious like a tracker in your your car, you're going to notice it. But if you create something like an RFID chip, no one will know, and it'll be blending in. And then, I pitched it, whatever. We won that, obviously. And no one's messing with me with that.
Yeah.
But the next year, I walk into the same teacher, Mr. Schwan. Shout out to Mr. Schwan. I had another class with him. He paused it as soon as I come into the class that first day after summer. He's like, hey, have you been on YouTube? I'm like, no. Why? He's like, let me show you something. So class starts. He plays this video of tile. He's like, Jay thought about this last year. He's like, he's behind. This was already in the motion for 3-4 years. But Jay, if you're not a businessman when you grow up, you're not following your true destiny. And I was like, God, that hit me. And I was like, wow. I didn't even think about it. For me, I was thinking everything so rationally. This is what's the market, everything that requires a businessman to think. I was already just thinking like that, and I didn't optimize it because I didn't know I was doing it. And then I started becoming intentional about it. And I was like, why do I want to be in business? What do I want from this franchising? And I realized I wanted 2 S's: sustainability and scalability. Right? My boy has a car shop. Right? You can't sustain that throughout the winter season, right? But if I buy the right type of asset class, I can sustain it throughout, no matter what market cycle is, no matter what period of interest rates it is. It's the sustainability and then the scalability. What systems can you implement to grow it with the team that you need, and where you can manage it, and the culture you sell will be the precedent of it. So I was like, okay, cool. And then I stumbled upon Grant Cardone. And then I was like, okay, this guy's a goofball, but I'm a goofball. So I'm like, I'm smarter than him at least, I know that about myself. So I was like, damn, he's showing me the blueprint of I can do this, I can do that. And I'm very questioning. I would have so many ideas, but I'd shut them down because I'm my biggest critic. I'm my biggest person I'm pitching myself to. And this just kept passing all the tests. And so I started diving in, and YouTube University, and I know you're going to ask about that later, but how to get into this. But yeah, long story short, that's how we ended up here. And then when I met Tedi, this is what he didn't mention. So the way that people look at stocks, how he's talking about hedge fund, most people look at stocks as a day-to-day trading kind of thing, right? Tedi was he would invest in this one, what's that one food thing that was at Target? That one.
Was it Beyond?
Beyond Meals. Beyond
Meat.
He would go to different Targets, and look at the stock in the stores. You know what I mean? He would do stuff like that. And I was like, bro, he's looking at things just like how Warren Buffett would fundamentally. Who are the people operating these companies? It was at the leadership role, right? And it's the control of that, because you have to trust them to control the asset and how it's moving. And I was like, bro, the fundamentals that you embody in your side of finance is the same in real estate, but with more control, more upside, more tax benefits, all this stuff. And I was like, dude, and he was way smarter than me. That's IB stuff, investment banking stuff. That's not stuff that I can handle. Real estate's a simple business. The sophistication comes with scale, which we can handle if you build the right systems. But I knew I needed Tedi, because I was like, bro, what you're optimizing and what you're feeling and gaining the satisfaction from what you're doing in stocks, you could do that at 10x here. And I feel like the rewards are 10x. And you can actually touch what you're doing. Beyond Meals, you go around and you can see what they're doing. But no, how about you buy your asset? You can touch the properties you're touching, you're renovating, etc. And after a year of putting it in his brain, he finally came around, Yep. Yeah, but yeah, long story short.
And when you guys initially became business partners,
yeah,
how did you realize you guys were good for each other? And a lot of people worry about getting into partnerships because they don't know if they can trust the other guy. How do you guys keep each other accountable on the trust aspect of it as well?
I think it was, the thing with me is a lot of people will come and see my crew from an outside, and they'll be like, oh, this guy probably has all yes men. Little does he know, Shrey is not no yes man. Kush is not a yes. We're going at each other's necks. It's just behind private, right?
Who are these guys?
These are the guys on my team. Shrey's
okay.
These are people that work with us, partners of ours. But from an outside, it's all glitz and glamour because we all notarize each other in the public. But behind closed doors, we're going at each other. The reason why I knew Tedi was going to be my partner and why I wanted him is because every time I told him something, he did not believe it, and he questioned it, and he was. Even if I showed you 2 + 2 = 4, and I brought you 2 sticks and I added 2 sticks and I showed him 4, he would still not believe it. He would do more due diligence to believe that 2 + 2 = 4. And I like that he never. I needed that, and it's not that I didn't have that before. It's he did it to the most, because he had his own reassurance. He was already doing his own things. He had his own pride in himself, and everybody needs that, And I like that we could battle with each other because he wasn't being ignorant to it. He just could not believe it at the times because of the industry that he was in. But I like that we could always go back and forth with each other. And for me, I elevate myself to the people around me. I don't need all the notoriety. My notoriety will come to the team in which they elevate themselves, in which we foster and garnish the culture. But I knew Teddy right away because he would not even believe the simplest things I tell him, and he would always be pushing back at what I'd say. So I knew that was the biggest thing I wanted in a partner. I wanted someone that was always going to be inquisitive from an intellectual perspective, not just from an ego perspective, like with real stuff backing what I'm saying and what he's saying to defend his point and the debate, not the argument. And I found that to be so satisfying because everybody that I know that I've ever encountered in my life, I've never had a long conversation with, And every time Teddy and I talk, we can go on and on and on because we have so much knowledge because he's always reading books. I'm always watching podcasts. I'm always talking to people. We have all these anecdotal plus learned experiences that we're bringing to the table for any topic, and I've never found someone I can go that deep with. You know what I mean?
Yeah,
So
it was pretty funny actually in the ABT days and even still now anywhere. We used to go at it so hard in like the corner, right? We would be in like the back little nook corner. Before you know, we just got in these long, like 30-minute conversations, and honestly, we might have ignored our work a little bit because we got so in depth. I remember there's one time specifically, we're in depth conversation. We look up, we look around. There's a crowd forming.
Yeah, that was crazy.
And that's like a regular.
Are they
occurrence.
listening to
Yeah,
you?
They're engaged listening, and it was like it wasn't even at ABT. It'll be. Well, obviously that's where it started, but there's like so many other places and so many other times where it's just like there's random like crowd would form around us because we got into these such deep conversations. And to be honest, nowadays I think a lot of people they're hungry to have deep conversations.
Yes, that's
true.
true.
There's so many surface level conversations. I'll be honest with you, I hate small talk. Like I'm not good at small talk. He's the best talker I know.
The best.
By far. And I will always say that. But it's just like we always had such intellectual conversations and debates. And as you just said a moment ago, it's like there's almost not another person where I have such good conversations with. Yeah. And we're like, all right, there's something to this.
To this day.
There's definitely something to it. And I think we both recognized it.
Yeah.
Sure. Now, I want to transition into investing, finding your first deal, and also pitching your investors on those first deals and how that went down because starting out, it's probably very nerve-wracking.
Oh, yeah.
Pitching to your first investors because you have no experience in purchasing real estate. So how did you get them to trust you with their hard-earned money to buy and earn the money?
You know what's funny? It wasn't really nerve-wracking for me. Like I never really... I don't know, man. Like whenever I believe in something, and it's because I'm my worst critic. I'm my own critic all the time. So when I'm like, dude, I can't even shut this idea down. I'm like, these people don't even know a grain of the information that I know. I can sell them anything at this point, As long as I can talk the way that I talk and with conviction, with passion, it's gonna be, and with the momentum of other investors. But early on, this is how I'd sell it. First of all, to get to the deal, Jack at Kaiser Group, shout out Jack. We just went to the mid-market summit. I told him straight up, when we're talking about small talk, I'm like, listen, Jack, I don't have any experience. You're gonna be worried about me closing. I have this mentor that's gonna guide me through the steps. I can close a deal. I have this loan officer that's gonna already show you that I can close. I have my guarantors. I can get this approved. So I eased the broker into the deal to favor to us, right? And his biggest thing was experience, and then him being able to close because that's his reputation. I was able to mitigate that. Jack's a younger broker, and I think he really took a liking to me just because of the way I carried myself. He was like, okay, you know what? This kid seems a little crazy, but I think I believe in him. And then with the investor side, I was like, okay, listen. If the bank is already going to be okay on the deal, then in the insurance broker, everybody's giving us the deal, and all we need is this puzzle.
So you got to the bank. You got approved before you even got a cent from any investor.
Yeah, that's the process.
Wow.
That's how syndication works. Like the money comes at the very end.
Got it.
You have to
What's that timeline that you have to get the money before you can actually close the deal?
So you just need enough to. So like if you in our model, like Teddy will be ultra conservative, right? So like if we need to raise $200,000, we're probably raising $275. So we don't need that full $275 at close. You just need that down payment amount, but. Throughout the process, there'll be a period where they'll ask for proof of funds, maybe like a month before not a proof of funds, but like to see that actual liquidity in the bank account, maybe like a month before close. But the first month is due diligence. Our first deal, it took months, you know what I mean? So the first step is the due diligence, getting the deal under contract, then weighing the due diligence, then going your attorney review. And then around there, you're rolling into the bank side of things. And then maybe like a week or two into that, you're going to be like, hey, let me see the money, But I already told the way that I would pitch these investors is like, hey, the bank is already on board. That's the biggest partner in the deal. That they're putting up 80% of the capital, and the broker's giving me the deal. I've already built this team. I have this system. Now it's like, oh, and I already have 5-6 investors already there. I only have to raise this much left. It's like they're like, okay, well, there's already pieces put together. I'd never go to them asking for money. I'd be like, hey, I have an opportunity for you. And I never was desperate about it. I was like, I'm gonna do this regardless. I always say, I'm like, you might not be interested now, but I'm still gonna do this regardless. It's an opportunity for you. And I might have been bullshitting back then, but it's because I had so much faith in myself that I'll find my way through it. Even if I didn't think I would be able to do it. But I mean, I never really was nervous. Like, it's even to this day, like, we have a big meeting with a big investor. I'm looking forward to going there. I'm not a bit nervous. Neither is Teddy, because we know what we have to offer. Like, I was never nervous because I put in the work. Every time we get nervous for a deal, like, this would happen in the beginning. It was never for the investors or for the broker. It was us in turn, like, yo, are we actually going to be able to hit these numbers? And then we'd be like, okay, the work would reassure us. Let's look at the market again. Let's look at the due diligence again. And we're like, okay, we're good. And we're so conservative based off those numbers, so like the confidence and the lack of nervousness really came from our preparations and the hard work,
And those first deals I remember, because we were always considering, hey, what markets do we want to be in? Where do you want to be located? Because that's one of the first questions you have to ask, right? Where is your real estate going to be located? So we fiddled around with the idea of like, oh, the border of Indiana and Chicago and Illinois, right? Oh, that might be okay. We're like, oh, maybe the south side. We're like, what about the north side? Oh, numbers don't pencil out. Then we kind of stumbled upon the west side opportunity, right? And so I think something that we were both very adamant about early on is making sure that there's enough conservatism and enough buffer in the numbers of the deal to be able to sustain this if something goes wrong, right? And so with that first 8 unit, which was actually 20 units, and then one of the sellers backed out, ended up only being 8. With that first deal, we realized there was so much inherent cash flow in the deal, and we knew that we could juice the returns so much. And if we are super conservative with the expenses, it's difficult for us to fail, right? So you're at a confined 8 units, so it's not too much to tackle, right? And mind you, all of us had 9-to-5s at the time.
Still do.
Right, still do. We all still do have 9-to-5s at this point in time, even though we're about to hit a little bit over 100 units soon. But with those first 8 units, we wanted to make sure that, okay, we can't fail this, right? We have to make sure that we succeed and we follow through with the business plan exactly, because that is going to build the momentum. That's going to give us the confidence. The investors are going to gain the confidence. And then we have such a large stepping stone to build and build and build, right? Which our 8 unit, that first year, what did it hit? Like 14% cash on cash?
After investors were paid
After investors are paid. And cash on cash is a metric. Basically, if you make $15,000 in profit, right, you take that amount divided by the total amount of money that all the investors put in the deal. So $15,000 divided by, let's say, $100,000 in equity, 15% cash on cash, right? And then once we saw that, we're like, man, we're killing it here. Like, we're onto something, right? Which also, to kind of jump subjects a little bit, that's how we stumbled into our strategy. So those 8 units.
I was going to ask your product strategy. What do you look for? And kind of that kind of stuff.
So I'll dive into that right now a little bit. So what we realized, it was all Section 8 tenants, those 8 tenants.
Except for one.
Except for one.
Do you want to explain Section 8 to the viewers?
Yeah, so Section 8 is essentially subsidized housing, right? It's low-income subsidized housing. So somebody who makes what is considered low income, depending on the area, median income, so the median income of the area, the moment that they make between X amount and X amount, it all depends on the area, then they can apply to the Chicago Housing Authority or other different subsidy programs. CLITIF is another one, and so on and so forth. They'll apply, and then the government will be like, okay, we processed your application, you make X amount of money, we'll give you a 2-bedroom voucher, a 1-bedroom voucher, and you can take that voucher to anybody that will accept the voucher, so any landlord that will accept the voucher. And then the way that the process kind of works is you'll go ahead and submit, let's say the tenant with the voucher wants a unit, you'll take their RTA packet, process the information, they'll do an inspection, right? The inspections are very thorough with the Chicago
City of Chicago does the inspection.
City of Chicago,
and what are they looking for?
So some of the things that they look for example, a smoke detector has to be within 15 feet of all entrances, right? And so certain units might have more smoke detectors than others. All windows have to open.
Everything's
all
up code.
Have to work.
Everything
is up to code.
Okay.
Everything has
if
to
they
work
have a
properly.
baby, then they're even more intensive about it.
Exactly. And so once you go ahead and have after you have the inspection, assuming that you pass, you can do re-inspections, right? But assuming that you pass, then they'll give you a rent determination. And what that means is, okay, they've decided for a 2-bedroom unit, we'll give you $1,600, right? And then after that, you can move the tenant in and the onboarding process, and then the tenant comes in there.
How do you get, let's say your expected rent for that unit is $2,000. how do you ask for that 400 extra?
So there's comps in the area. So CHA typically pays about 90% more above market. So like if your rent is $1,000, they'll pay like 190. You know what I mean? Like they'll pay more. They'll pay way more. And if you have ADA compliances, they'll pay 400% more. You know, like it's long term. And the best part about CHA is they're long term tenants. A person that will rent from you that's CHA will live there for 5 to 7 years. Eliminates turnover costs. You know, and it also builds a community in your asset class, which retains everybody's customer satisfaction, if you want to call it. And as long as you're doing your part, maintaining the property, no one's ever going to want to leave, you know? But to answer your question about rent determination and rent increases, when we first bought, this is how we knew we were onto something. We bought that asset, the A unit. The average one was $1,000. The 12 units that backed out during due diligence, we saw that the rents were $1,300, and their units were superior to the A units that we bought. But they're all subsidized. And I was like, okay, well, I just stumbled upon the CHA website, put my portal in, it said rent increase. I'm like, well, I want a rent increase. So I put up $1,300 just because it was comparative to the exact cookie cutter units, the 12 units that backed out were $1,300. So I just applied for $1,300. I got $1,300. I was like, what the heck? This is crazy. So then the next building we bought was a 16 unit, same thing, $1,000. But by then, the rents went up to about $1,400, you know, and you're looking at the market. There's a website called affordablehousing.com, which is like the apartments.com, you know, for like, you know, just normal living. And affordablehousing.com is partnered with CHA. So when they ask for your comps, whenever you're submitting the RTA packet from your subject address within a mile radius, you have to submit comparables that, you know, justify the rent that you're asking for. So of course there's lowers, of course there's less. There's no median, there's no average. You show the comps, and as long as you support it, then you're going to get the rent. And
So you're already adding fiscal value to your property
just on
applying.
The buy. Just on the buy. Just on the buy.
Automatically.
And so that's how our whole strategy became, okay, these are all market rate tenants. They're market rate tenants because his owner bought this asset 15 years ago, 10 years ago. He has cash flow to the roof. Why would he want to renovate this unit? Why would he want to increase rent and risk this tenant leaving? Let me just cash flow. So we'll buy those assets that are undervalued in terms of the actual product, and then obviously the market rent, and then we'll just do little light renovations, and then just put in the subsidy tenants and get market rent, if not a little bit more. You know.
What do you consider light renovations, and how do you?
I'll let Teddy get into that.
And how do you determine if I buy this property, are we going to just gut everything, or are we just going to do light? You know.
I mean, but before you get into that, sure. we go into that knowing like we're not going to go above a certain price per door. We're only going to buy units that are above 60 to about 82,000 a door, where we can put in max 15,000 a door to get us at 100, because we know the market where it's going to trade for, etc. But I'll let you get into that.
So I coined this term, I guess you could call it. I don't know if any other real estate
No, you coined it. You coined it.
I call it PBA, so paint buff appliances, right? Which basically means you paint the unit. You buff the floors, or you'll do LVT flooring, depending on how you want to go.
Depending on how bad they are, you know.
Exactly. And then you'll go ahead and put in new appliances, right? In the case of our 38-unit portfolio, which we're undergoing right now, and we should be finishing in about the end of summer, basically, what we did was we got nicer cabinetry. So we put new cabinetry in there. We put a new vanity in the bathroom, a new mirror in the bathroom, new toilet, paint the tub, new shower head, right? And so all these little things, we figured out it's basically you're looking to meet the standards of the market. Right, and maybe go a little bit beyond that depending on your hold period. If you're looking to flip a property in, let's say, 3 years or so, or even an 18-month timeline if you're doing like a construction loan or something like that, maybe you're not going to go on the highest end and get like the most durable. You're not going to get the most durable cabinets, the most durable countertops, but you're still going to make everything nice, right? If you're trying to hold the property for 30 years, as we're starting to do with this new strategy with our new development partner, now we're starting to put a little bit more into the unit. So instead of, let's say, $10,000 in CapEx per unit, CapEx is capital expenditures, right? Maybe we'll go $15,000. So we'll get higher durable quality products in there so it can sustain the hold period over the 30 years, right? But realistically, at the end of the day, if the area is not calling for granite countertops, probably shouldn't put granite countertops in there. If the area is not calling for one of those, call it a smart fridge where you can tap or watch YouTube on it, you probably shouldn't put a YouTube fridge in there. I mean, I don't even have a YouTube fridge in my house. But anyway, you kind of meet the standards of the market and you match it with your business plan, and then you kind of figure out a nice little middle ground. And that's kind of what we did.
You see YouTube fridge.
Now, I want to go back a little bit to you guys when you're looking for a deal during the due diligence period, or even right after when you actually hopped in the apartment complex. Do you guys have any horror stories? Anything went terribly wrong? If you want to get into that.
I mean, one thing that I'll say is like, due diligence is just a matter of the trust between the two people. Because for our 16 unit, this guy told us that all the tenants pay for their utilities. later when he's showing us all during due diligence, the owner is supposed to give you all of the receipts of all the expenses that he pays for. And then we close that deal and we find out there's 3 tenants that he was paying for the gas, heat, and electric. I'm like, bro, like he didn't tell us that up front, you know? So it's like some people, and he was in a desperate situation. He was trying to get rid of the building because he was going through a divorce. He needed to liquidate. So it's like what you'll find is that there's not a lot of honesty, and there's always going to be a schmuck trying to make a quick penny. But I mean, you can't even kind of find out that, you know. I mean, there's been times where we'll buy a building and there's like, you know, drug dealers in the building, or the numbers don't match up to what they're actually saying. But I mean, that's why we do our own internal. Like Teddy does a great job when we're during our underwriting, where we have our actual, where we think whatever the marketing package says, the OM is garbage anyways. What is this property actually running at? You know, this is the money coming in. You can verify that. But now let's fabricate the expenses based off what we've seen and what we're experiencing based off comps, whatever it is. You know,
You're like a detective, basically.
Yeah, basically. That's due diligence. But I mean, this one horror story, I mean, during due diligence, like it's what, like I said, it's all the relationship between the buyer and the seller. And this one seller, we're closing the deal right now. This guy, man, we had to save the deal like 2-3 times because he was just being a hard ass. You know, like we were requesting the most basic language to go in our favor. We wanted tax prorations to go in our favor, just market standard, not even anything crazy, just market standard. And he was just being a stickler. Like I remember during our attorney call, like I didn't know who was the attorney. I didn't know if the seller was the attorney or his attorney was the attorney because he was doing all the talking. You know, and like, you know, even for there's just so many conflicts that come up, but you can just do your part by being the biggest term in due diligence is good faith. You know, and as long as we're operating in good faith, I mean, that's you can only hold up your end of the bargain. But I mean, people are going to be shady. People are going to find ways to pull a fast one. But as long as you have the conservative buffers in your underwriting model, which Teddy is overly conservative, then you're going to be just fine.
And
you know?
and I'll say this: it's like you're always gonna find what I call skeletons in the closet. So there's gonna be plumbing issues. There's gonna be leaks. I mean, in the city of Chicago, it's a very old city. All these buildings tend to be, call it 1920 build on average, at least the ones that we're acquiring, right? So you already know right off the bat there's gonna be plumbing issues. And so that's why you build a contingency, so a little bit extra on top of your CapEx so you can take care of those things, right? Most recently, we're actually in the closing process for another deal as well. And we get in there, I mean, there are a crazy number of leaks. They couldn't even get a camera through the sewer scope because all the sewer lines, 5 in total, were just backed up. And it's like, these are things where it's like, as an owner, how do you not know about these things?
No,
like,
he did know because right
they
after,
do, I was gonna say,
during
they do, they
inspection,
don't
when
say
we
it.
saw that, Teddy gets an email the next day. We didn't even say anything. Oh, by the way, the seller did rotted this. It's like, bro, like, how are you as an owner just letting your tenants live like this? You know, it's
but we capitalize on that, right? So what we do is we look for owners that are ready to retire.
Tired landlords.
Yeah, tired landlords is what we call them. Like, all right, there's like we bought the 38 unit portfolio off an individual who was what, like 76
83.
years old.
No, he was 83, bro.
83. He was moving pretty good for 83 though.
He was.
But I'll say this.
He was getting taken advantage of though.
Oh, for sure he was getting taken advantage of, which is our opportunity, but also kind of the annoying aspect of it, right? Because if you have so many issues with the building that they don't disclose, now we have to take care of all those issues, which is time and money, right? And it's a little bit of a headache, right? But in the case of our 16 unit that we had, the second building that we had purchased, we took care of everything. And then by the time that a year and a half or 2 years rolls around and you take care of everything, now you're smooth sailing, right? You go ahead and you submit your rent increases every year. And you'll have a little bit of CapEx projects here and there, a leak here and there, but for the most part, you don't really hear much, right? It's a peep. And you have to also know the tenants. You have to be really hard about the tenants that you put in your building, right? So we're looking for typically like older couples, right? Because they're not gonna hurt your unit, and they don't really move around. They don't have kids that are gonna like write with crayons on the wall or something like that, right? And so as long as you take care of all the projects up front, make sure that you're leasing really well, and then just execute and always follow up on repairs and maintenance that they have and take care of all their requests. 1, you have a tenant for life. 2, you'll get your rent increases every year, assuming that you're doing like a Section 8 subsidy program. And then 3, you're going to have a well-maintained building, right? So then you could hold it for as long as you want to, or as long as your business plan calls for.
Now, what happens if a Section 8 tenant, let's say, completely demolishes your unit? How do you get, because what if the security deposit doesn't cover the damages to your unit? How do you recover those costs? Does the city pay you guys?
So I can take that. I mean, a lot of investors ask me that right away, and that used to be true 20 years ago, but nowadays with the insane roar of inflation and the lack thereof of affordable housing, the government is a subsidy in themselves. If they don't, why do they have opportunity zones? Why do they have all these programs that incentivize the free market people? Because they're the biggest syndication firm there is. They're running this operation, and what they don't know how to do, they defer and put incentives out for people. people. So now affordable housing is one of the biggest crises in the nation. So they have to partner with the landlord. So now, Teddy was talking about it earlier, the RTA packet, if you're low income, you submit whatever, then you get approved. Right now, there's about 30,000 people waiting for a voucher in the city of Chicago alone. So there's supply and demand that goes towards our favor.
And how many get unlocked every year?
I'm not sure what that is. I don't know. I think there's a system where people eventually get off the voucher program. We've had that happen with a couple tenants, and then new people get in because it's supposed to be a temporary thing where the government is aiding you throughout a hard time to get to a better place.
So like a specific year amount?
I mean, there's not really, it all depends on the family. I mean, it really comes down to the family. There's not a timeline that they put on there. The new administration's doing that. Like they're putting a timeline. There's all this stuff on the news like, oh, they're going to take away Section 8. They're not trying to take away Section 8. They're trying to enforce what Section 8 is made for. It's a temporary relief to help you out to get through a bad time, which people have been taking advantage of.
It's a stepping stone.
It's a stepping stone. But what I tell investors all the time is, no, what you've heard is true. But nowadays, the supply and demand, which I just mentioned, CHA works both ways. If we're not taking care of the building, the tenants can call CHA on us. And if they come and inspect the building, they give us a time frame of when to fix it. If we don't, they put us through an abatement where we don't get paid. So if you get enough of those units, you can get foreclosed on. So I like that because I always like to flip the script, is what I call it. Everything that's bad, I just flip it to good. I'm like, yeah, but I don't mind that. Oh well, the people that don't want to deal with all that inspection stuff, they're just being lazy. I'd rather know about the problem, deal with it up front, make sure my building's well shaped, ready to go. So when I have to sell or anything like that, I have an inspection from a bank or an insurance company. My building's always up to par. The other thing, it also goes both ways. So like I said, the tenants can do that, but we can also do that. If a tenant smokes in our property when they don't want to, if they're breaking doors down, whatever it is, we can call CHA on them and then they get their voucher pulled. So they don't want to lose free housing. So before it wasn't like this, but now with the lack of affordable housing, with the increase of inflation, this is a severe problem in today's economy and today's society. So now it's not really like that anymore. And we haven't had any tenants do that. The tenants that do that are the ones that are market rate. Because they don't give a shit, Whereas these people have something to lose on subsidy, It's hard to get through that process,
But the tenant can also call Section 8 on us, right? They can be like, hey, my stove isn't working and they haven't taken care of it for like a month or something like that. We're really good with maintenance, so that rarely ever happens, right? And what we've had cases of is like, for example, a tenant may threaten to call Section 8 or something like that, or maybe they do call Section 8 and we literally take care of it the next day, and then they're like, all right, I'll talk to my case manager and we'll go ahead and have to not do that inspection, right? So we've only ever gotten called Section 8 on us like twice, right? And mind you, we've been in operation for 3 years. Yeah. So we're really good on top of maintenance and we're really good on building a connection with our tenants, right?
Also, like when that happens sometimes, like tenants don't know that, like because we don't have a portal, right? Like where you can put in your rent maintenance request, and we do that intentionally because our service is the reason why people will stay. So these rent increases, right? Now we're kind of strategically planning how we renovate these units because the buildings that we're going to hold for 30 years, when we bought our first building, the average one was $1,000. Now it's $1,900. So there's only so much you can do where, okay, I've renovated your entire unit. Now I'm going from a $1,600. I've renovated your unit completely and you're at $1,600. Now I'm submitting for $1,900. There's nothing I can do to revamp your unit. It's the service that retains it. How fast are you turning to maintenance requests? How less institutionalized is the process where you're going through this portal and like, you don't really know if someone's going to get back to you. And like, you ever go on a website and you're like, bro, I just want to talk to somebody. You call somebody and it's like, there's a robot. Like, I don't want to deal with that, Yeah. So the way that we've set up our systems is we have a guy that deals with everything and relays it over to us. And although it's the headache, everything's a headache that we've been talking about, but it's a sweat equity which we profit on, So then we know that about our business plan, and the sustainability it's easy to manage if it's streamlined and the systems are built. But at the end of the day, that inspection, there's no portal. So that inspection gets scheduled because the tenant's like, well, how else am I going to communicate it? And once again, full accountability. We're like, yo, that's on us. We should have told them if you have maintenance requests, text this number, But that rarely happens. And if it does happen, like it's a reality check, like, hey, maybe we're not being good landlords. And like I said, it's all coming back to us. And if we want to hold these buildings for a long time, we don't want these tenants to move out, save money on turnover. It's the service. And at the end of the day, the upkeep of the building is the biggest thing, because you can live in a high-rise building, and if people don't tend to it, they're not going to renew their lease. It's no matter what asset class you're in.
And to speak on that service is like our service goes so great. As for an example, we had a tenant, her daughter had unfortunately passed away. Like a few of us had went to their funeral, right? Like something like that goes so far. We had another individual who couldn't afford like their diabetes medication, right? And they need a small amount of money, so it's like, here you go, just pay us.
One
back
tenant
when
wanted
you can.
soup,
right?
Like,
one tenant wanted soup because they have cancer and they needed soup, right? It's these type of things. That's why we always pride ourselves, and our slogan says "A family business" underneath some of our logos, right? because we have that personalized touch, and that's what we really value. And honestly, I don't think we ever want to let go of that. Although what I will say is sometimes you get way too large. Let's say an individual has 1,000 or 2,000 units. You can lose that personalized touch, and chances are you will lose some of it. Like it's gonna happen. It's gonna happen. But as long as you try your absolute best to maintain that level of service, maintain that level of connection, then that goes really
It's
far.
the effort that counts, like
Exactly.
you can't tend to a person like that every time, especially when you have 1,000 units. But if your effort is there, they're gonna feel it. Okay, I've lived in this area for 10 years. This is the best management company there is, but hands down. Even if they can't do it every single time, it's like the effort is there. Whereas other people don't even care to show any effort, and that just differentiates us to begin with.
Also, another thing is I'll say we have the best units in the area.
Yeah,
by
we do.
far.
We
By
do.
far. I mean,
Yeah.
these units sell themselves.
Yeah.
We've had people who they'll live in really nice condos, right? And they'll step into some of our units and damn,
And
did I
that's
live
something
in here?
intentionally that we look for. Like when I tell Teddy, Teddy's like, yo, I don't know if I want to tour this building. The units are 600 square feet. I'm like, well, go in and take a look for it. Maybe they feel big, Maybe a unit that is 1,000 square feet on paper feels small, like the feel, that stuff is not on the papers, and that's our biggest thing. Like when we buy a building, we're like, okay, we're going to obviously have the best finishes, but look at how big it is. People are not going to want to leave here,
Exactly. And I mean, and when you're on YouTube University learning about these things, they don't teach you the small
Yeah, they
little things
don't,
about
yeah.
leasability. For example, if you have a lot of windows, your unit looks bigger. If you have white paint, your unit looks bigger.
Mm-hmm.
If you have a carpet versus, regular flooring, that's a lot more nicer to the tenants.
Mm-hmm.
They don't teach you these things. And I hope that these individuals who are teaching others are not trying to gatekeep this information. We're certainly not. We're
Yeah.
here saying it on a podcast.
Yeah.
So, and these are just some of the tricks of the trade, so to speak.
Mm-hmm. Now, I want to get into the numbers, the underwriting. What numbers do you guys target for when you look for a deal? And the value you add, what number do you try to hit?
I'll let Teddy
What's the
take that
difference?
out. Teddy deals with all that.
Yeah, so I mean, certainly what we always like to say is 2 to 3x your money in 3 to 5 years, right? And what we learned about the first couple of deals we had, at first we're like, oh, we're just going to aim for the 2x or maybe a 1.8x of your money. But then we realized by increasing the rental income so much higher due to Section 8, by providing the great value, by giving the great service.
ASAP program.
And the ASAP program as well. ASAP program, just to quickly dive into that, is essentially a program if you put $8 per square foot, right, per livable square foot area. And part of that also includes putting $8 into 2 primary building systems, but it's all kind of bundled into that $8 per square
renovations?
foot.
Yeah,
renovations.
It's like the Class 9 program, if you've heard of
Exactly.
that back in the day. It's
the same. The Class 9 essentially changed into this ASAP program. But if you do that and you can go ahead and provide proof to the government, or the local government at least, then you can get a 25% tax reduction. And there's 3 tiers to it, but the one that we're targeting right now is
And it's a
$8
30-year
per square
program,
foot.
too.
30-year program,
Yeah.
exactly. So the combination of, like I said, the rental increases, the services that we provide, as well as this ASAP program, now we're seeing it's honestly pretty easy or we're starting to see we really think we're going to 3x.
Yeah.
I don't want to say anything's easy,
Yeah.
right? And I will say we haven't gone quite full cycle yet. And what we're seeing on the cash flow side of things, though, is typically at least a 10%, right? 10% minimum. And then, like I said, with that first 8 unit, we saw a 14% that year one.
And you pay your investors every
This is
quarter.
after. This is,
all quarterly.
After, yeah.
Yeah.
Before they even
This is after our fees.
Yeah, after our
Yeah.
fees.
Oh,
So,
wow. Okay.
Yeah.
so some of the fees that we charge is a 2% acquisition fee, which is basically 2% of the purchase price. We'll raise that money, and that money will go to us. And why do we get that money? Well, we found the deal. We took care of the closing process. We took the time out of our day to
Kind of
make
like a
sure.
brokerage fee at the end of the
Yeah,
day.
Exactly.
It's the same exact
Exactly.
thing.
Yeah.
Then
That's
there's
exactly
there's
what it
an
is.
asset management fee, which is essentially just 2% of all cash flow that's collected, and that's something just basically to keep the operations going.
Just
right?
overhead, the CRMs and softwares.
Exactly.
And,
Obviously every business has certain expenses that they.
I mean,
have
you're
to
not
pay.
doing this for free.
Yeah.
No.
Yeah.
And so those are the returns that we've been targeting. Like I said, once again, we haven't gotten full cycle on the deal, but with the trajectory that we're going, we really do think we're going to start hitting these returns that other operators cannot provide. But I will note one last thing. Because we operate in what's called the middle market, right? So these deals aren't so tiny that they're 6 or 7 units, and they're not so big that they're 75 units. This middle market is the area where, because there's these tired landlords and it's a lot of mom and pop operators, it's not institutional operators in New York or something like that.
But the scalability is not, the mom and pops have trouble managing still.
Yeah.
Exactly,
Right?
and
Yeah.
that's where we come in. We provide the institutional feel, but in that middle
Well,
market.
it's a systems issue. That's what it comes down
It
to.
is, exactly.
Going to like the returns part. I mean, before we started getting ESAP program, before we started getting $1,900 for a 2-bedroom, back when we started it was $1,300. This substantial increase. We still factored like $1,400-1,500 for 2 beds. Like now, even when we're underwriting, the fact that we were so conservative in our initial underwriting, when we get these increases, like it's even hard for us to say comfortably we're going to 3x money, because it's like, dude, is this even real? But like, no, it is real, because when we've underwritten to our 16 unit, our average rent goal was $1,300. We're already at $1,500-1,600 right now. With the ASAP program, which we just applied for, it's going to be even higher. So it's like, and this is the thing that I'll tell investors. I don't even care if this building appreciates or not, because I know it will. But if I'm going to give you 50, like the cash flow that I give you during a 5-year period, whatever, if I raise $450,000 on a deal, I'm going to double your money just through the cash flow of a deal, even if the building sells for the exact same amount. And that's rare, because you have principal reduction, So, and you're going to have some kind of appreciation because it's mass inflation. Our cash flow, our in-place cap rate goes up so high on the buy because of our strategy, that even if I were to sell the building at break-even price, you'd still double your money. And you get tax benefits. So if you have businesses, you roll over that extra losses to your other businesses, cash out gains. It's that bulletproof, and it's because of the level of conservatism in which we operate.
I want to dive a little bit into those tax loopholes you guys use. Is there anything that the common person may not know when buying, even if someone wants to buy like a 2-3 unit building?
I mean, a lot of people don't know about cost segregation. Like, they just don't know what it is. Like I know I meet a bunch of people that buy duplex and stuff, like, but those people are not even operating it like that. Like, they're not looking at it like, oh, I have a business. I just bought a duplex, but they're advertising themselves like they're some business guy. But that's another story. But I mean, I think the biggest thing is it depends on who you're pitching it to, right? So like, if I go to a guy that has a chiropractor clinic, which I do, and he's invested, that guy will be like, okay, I can invest, but what's my upside? I'm like, well, first of all, when I say you get 15% cash on cash or 10% cash on cash, you truly get that because of the depreciation. But because of Donald Trump's putting 100% bonus depreciation back in the cycle of things, what that allows you to do is, if a deal is, so the way that it works, I can explain it very simply, where it's just simple numbers, because I do this all the time. If you have $1 million deal, what bonus depreciation allows you to do is claim 100% of the depreciable property year one. A building is depreciated by land and building. You can't depreciate land, you can depreciate building.
So for 30 years usually, right?
Yeah, for 30 years. Yeah. And for 30 years, it's $27.50. You can divide that building by 27.5, and then that's your yearly deduction. Okay, yeah. So if you have a $100 million building, you can depreciate 20. You can't depreciate the 20%. So $200,000 is gone. You have $800,000. $800,000 divided by 27 years is about $30,000 a year, in which you can depreciate on paper. So if you're building $1 million building, is doing $100,000 in net income. So of that, every year you can write off $30,000 already. So now you're paying tax on $70,000. That's normal straight line depreciation that accountants use. Bonus depreciation allows you to take the whole $800,000 up front. So that's just the normal building cycle, the 27.5. Bonus depreciation allows you with cost segregation. So an accountant is looking at it like this: what is the land in the building? Cost segregation is a third-party engineering firm that comes in and looks at the depreciation cycle of everything internal to the unit, that internal to the building, that has a life cycle less than 15 years. Asphalt, electrical wires, your appliances, your TVs, all this stuff. They look at all of that. And with that, you get to the $800,000 and you can take that up front. So now if your business plan is 3 years, $800,000 divided by 3, that's a large amount of money. You're only doing $100,000 a year in net income. You might be reporting a loss of $150K, $200K a year. So if us three are partners and we each put up $33,000, we split that whole loss. So I'm going to pocket my 10% cash on cash or my 15% cash on cash, tax free. Now I have this abundance of depreciation that I still have. So if you're a person that's a chiropractor, you're doing $500,000 a year, you can take off $100,000 if you're, of that extra depreciation and pocket that into your pocket. Like, that's why people buy real estate. A lot of these big firms don't care about why do you think people buy 3-cap buildings? People don't care about the cash flow. They care about, I'm going to get a substantial chunk of depreciation that's going to offset my other businesses. But that's on a sophisticated level. The average person is looking at it like, okay, if I put my money in the stock market, I get 8%. Or if they're looking for cash flow, they're investing in dividend stocks, where it's like, bro, you're still going to, dividend stocks you pay double tax on. Yeah. Yep. Whereas with real estate, I'm going to give you that full amount.
Capital gains and personal.
Exactly. Yeah. So whereas with real estate, it's like you're netting the true amount.
And also there's a real estate professional box that you can check, which essentially means
you have to be a real estate professional.
You have to be a real estate professional, which in the tax code, what that essentially means is putting 16 hours,
14 hours a week.
It's 14 hours a week, right? into real estate activities, right? So for example, like my 9 to 5 is in real estate, and we obviously have our business, right? So I can check my real estate investor box, right? What that means is after the cost seg, as soon as we have that loss of income, it shows a loss at the end of the year. I can take all that money and write off my W-2 income. So I could tell you the amount of taxes that a normal person would pay is far higher than what I would pay just because I've written off so much of my W-2 income, right? This also assumes that you're constantly reinvesting into deals, constantly just investing into real estate, which honestly I think is it's not only a tax strategy, but a great investment strategy in its own way.
I mean, even talking about that, the reinvestment, a 1031 exchange is one of the most superior tactics there is in real estate. 1031 exchange basically allows you to defer your taxes onto the next property as long as it's equal or greater value. So that's an infinite. If you and your spouse decide to buy one property for your entire life and you guys are maximizing the value, you have a gain on it, you want to sell and move to a bigger project, you and your spouse can just put up one down payment, 500 grand. You each put up 250 grand, bought a $2 million property. Now you guys don't ever want to spend any money on your investments again. You have your 401ks. If you guys keep 1031 exchanging that asset, you're going to be 50x greater than the normal person retiring. And that's simply because of one tax strategy. Not to mention the amount of innate cash flow that you're actually going to pocket because of a cost segregation study. But the 1031 exchange is really, really unique because it's on the exit and it allows you to defer all of your taxes, all of it, and it's, but it's incentivized economically because it keeps the money flowing in the market. So this is not just done for free. It's not just done because the government wants to help you out. There's a reason behind this, and it's because real estate's one of the hardest industries to be in, especially subsidizes the real estate where it's affordable, and then obviously keep the money pooling in the economy.
And I will say one thing to always know is think about compound interest, right? So the rate at which your money multiplies by itself. And so if you're taking those write-offs, right, and now you have more money in your pocket.
There's more money to invest.
And you have more money to invest. So now I'm going to invest that money, keep reinvesting. But the first $10,000 I invest, imagine if I keep reinvesting that $10,000, how many times I flip that bag?
Yeah.
But that $10,000 is going to be a great sum of money in 40 years, assuming you keep reinvesting that amount.
Yeah.
Einstein said, I don't know how the saying goes, but compound interest was one of like the world's greatest wonders or something along those lines. And really, if you think about it, and I've ran the math on it with our strategy, if you were to invest $25,000 every year for 10 years straight, you're going to be a millionaire.
He made an article about it.
I made an article about it
before we started marketing. He used to make a lot of articles.
Blogs on your website.
Yeah,
right?
yeah, the blogs. Yeah.
I saw a few of those.
One thing I want to say about the 1031 exchange, which is really something that I want to put out there. Property taxes are the biggest reason why the 1031 exchange even exists. Because if you have a 1031 exchange, if I bought a property for $1 million, now it's worth $2 million, I have $1 million of tax that I have about 35%, capital gains is 20%. So I'm going to lose about 200 grand of that money, right? Instead of doing that, they'll allow you to defer the entire $2 million into an asset that's greater or equal value. Well, why is that beneficial? Why does that help the economy? Well, because every time you buy a new asset, it's going to retrade the purchase price is higher than the last person that bought it, which means it's going to get assessed at that price. So the money is pooling back into the economy, and your property tax bill is going to go higher. And if this keeps happening, you get that tax deferred, and they get to win by increasing your property tax bill. You know what I mean? But if you're buying it inherently with value add, it doesn't matter, et cetera, et cetera.
Now, what's the future of JT Acquisition? When are you guys having the 75th floor of the Willis Tower? What's the future like? I know you guys are still in your 9 to 5s.
Yeah.
What does it look like?
I mean, I'll give a simple term. I mean, he alluded to the $1 billion. For us, it's like we want to build a sustainable cash flow portfolio, $100 million on the west side. We don't have to do a bad deal just to get an acquisition fee. Where this sustains ourselves, our overhead, all salaries, everything. And then on a shorter scale of things, I mean, we want to build that $100 million, but we want to start developing. We've strategically partnered with this development firm because, as he mentioned, the ASAP program, you can get development credits and have 100% of your tax bill deducted. But we also want to dive into different markets. Like, I know Teddy has aspirations to really. For me, it's like I want to get to the $100 million, and then I want to start developing and stuff. But he's really in depth about what he wants to do moving forward. And for me, it's like I just want to get there first.
Are you guys going out of Chicago too? Possibly.
We probably will. I will say. I mean, like you said, $100 million on the west side is the first thing. Getting into developments, maybe we're probably on like the border of Indiana, like Gary, Indiana is starting to be a hot market, and in the coming years, I think it'll grow. But honestly, to a certain degree, it's almost hard to say what the future is going to look like past that $100 million besides development. Maybe what we may choose to do is maybe we may have a general construction arm. Maybe we might open up a brokerage shop. Maybe we might do asset management. Who knows? Maybe we may choose to build like a PM software that combines with this CRM
we've been
system.
talking about that
I've been talking about we've been talking about that for years. But really what the future holds past the 100 million and past the development is still up in the air, right? Because there's no reason to get too ahead of yourself. I always say
Focus on
we
today.
always say it.
Yeah.
Don't
on
bite
today.
off more than you could chew, one day at a time, like we talked about just before this podcast, and just really just slow and steady wins the race. And so at the end of the day, 100 million West Side development, then from there maybe we do GC shop, maybe we go ahead and open a brokerage company, and then who knows, maybe we'll go all the way to Miami.
I think
don't know.
the biggest thing is like just building the systems, right? Because for us to even get there, it's like it doesn't matter what the future holds. It's like the future should be absorbed into your system. So like if you want to start venturing out into like a brokerage arm, or you want to start a PM software, we're like, you know what? We've had so much intense operational experience, not a class B, class A property management. It's like, no, we're in the mud, you know, like we have so much intrinsic value to add to a software that has all these defects that don't, you know, maximize true property management. And we're like, okay, cool. But at the same time, we built a system. So if a good deal comes across our desk, we just put it in the system and it should be able to operate itself. And that allows us to have the time to be inquisitive and you know, just perceptive to different things that can enhance the business that we already operate in. But it's building that well-oiled machine where you can just keep observing the funnel, you know?
And into that also, the reason why we say 100 million on the West Side is because that sustains us, right? That allows us to keep everybody on payroll.
Yeah.
That allows us to figure out our
To
next
even think
move.
that next step.
Exactly,
you know?
to
Yeah.
think that next step. So
Yeah.
that is the foundation. That is the base, right? And then from there, that's why I say we almost don't know, because we can do anything after that.
I think I kind of skipped past it when you guys said that the day to day. It's like we don't. I understand why you mentioned it now that I'm reflecting about it. It's like for me, I rewinded back to the systems. It's like I don't really. When Teddy says that we're going to be $1 billion company, I have no doubt about that because of the systems we're building. But it's like we don't care about like that. It's like what are we doing every single day to make ourselves better, you know? And it's like that's what like really matters. And like I don't care about the fiscal reward of where we're at. It's like, is my team growing every year? Are the people getting sharper every year? Because with that innately will come these ideas of the next steps. But without that, it's like you're just dreaming, you know? You're not working towards anything. And every day we're working towards bettering ourselves, bettering our product, bettering our service, and bettering the relationships that we have with our investors and with each other and with our families, you know?
And so many people say it's all about the people.
Yeah,
It's
it is.
all about the people.
You know, I don't know who said this, but it's like if you want to become a millionaire, build systems. If you want to be a billionaire, you have to build people. You know what I mean? And like we do that organically, not even for the money. It's just like the biggest satisfaction I get in my life is not 3xing your money. It's the impact that I have on you, where you believe in so much. Like my team believes in me, or the investors believe in us so much. Where it's like I believe in, like we have investors that pitch for us now. Like if I 3x your money, you're gonna be like, bro, bring your money here because you love your boy so much.
Exactly.
You know, and it's like the impact. And it's like now when that kid is when that your friend has a kid and he's like, hey man, like I want to get into real estate, like well, our doors are open. Come by. Here's an internship. You know what I mean? And it's like not a robotic internship. Like no, you're gonna come in. You might not be working on stuff, but you're gonna be listening because you see how the way we operate. You know,
This is why we say on our website, we're helping people build their education and also their finances at the same time.
Yeah.
They go hand in hand every single time.
Yeah.
And I want to rewind to what you said, Teddy, earlier. You said you want to wake up and do good work with people you like, right?
Yeah.
I think that's kind of everybody's
Yeah.
goal at the end of the day,
Yeah.
right?
Yeah.
But you know, a lot of that is on you though. You know, like you can wake up every day. If I post a Lamborghini on my Instagram tomorrow, right? You're gonna be like, bro, I'm so inspired. Like if Jay can do it, I could do it. Teddy will be like, bro, who is this guy? Who does he think he is? You know, it's like for you to be in an environment receptive to love, receptive to positive energy, you have to love yourself and what you do every day. If you're not putting your best foot forward every day, the people around you could be amazing, but you're bitter. You know what I mean?
Yeah.
It's on you, bro. You know, and the culture dictates that. You know, and we do a good job of weeding those people out. You know,
For sure.
Now, we got a few more minutes left. Last thing I want to talk about is any advice you guys have, either real estate related or life related, just real quick.
Yeah, man. I mean, I'd say if you want to get in real estate, this is the guideline of how to do it. I talked to this guy on the phone. He hit me up a couple days ago for advice. Go to Grant Cardone to build your mindset. Well, the biggest thing that I learned from Grant Cardone is you don't want to be the millionaire debating between buying a used car or a new car. We all know that one guy that's a millionaire on paper with his 401k and equity in his house, but he has to debate between a new and used car. That unlocks your mindset to abundance. The second thing is go to Michael Blanc, get a little bit more in the weeds, be a little bit more technical, and then go to Joe Fairless, learn your business plan, learn top to bottom how to do everything. It's a big fat red book. If you want to learn to do what we do, watch all the videos and read those books. In terms of life advice, I think the biggest thing is just always blame yourself, always take accountability yourself, and always every single day you're going to expect a problem. You can judge a man by the type of problems that he has in his life. Embrace that, and the moment you get down about it, or you can't pedal through it, you probably don't love what you do. And if you're doing it for money, you're not going to get there. So find your passion where you're happy to talk about your problems. Make sure you're passionate. That's the biggest thing I'd say.
Yeah, but what I would say is spend a lot of time, a significant amount of time figuring out what you want to do. Like, what do you want? Because I think the moment that you know what you want, and I'm saying get honed in, really figure it out, and ask yourself, am I willing to give up XYZ thing? Is my personality catered to this goal, right? So if I'm going ahead and I'm thinking, I really want to build a restaurant, right? But I'm not truly passionate and I've spent, call it 1 day thinking about it, it's like, you're going to fail, man. Like, you are bound to, you almost
when it gets hard,
you're going to quit.
Yeah.
You're going to fly out the window, you're going to get quit. So figure out what you want, because the worst thing that could happen is you're 10, 15 years into this game of what you thought that you wanted, but realistically you don't care anymore, and now you're depressed because you hate the position that you're in, right? So if you're even if you're 30, 35, 40, doesn't matter what age, like, figure out what you want and stick to that thing, and then that aspect of compound interest, that's going to carry you through into fruition.
And it goes into the why, right? And I think the second thing is, like, he's talking about, like, figure out what you want. I think the biggest thing is you have to understand who you are and what you want to get out of the goal of what you're in. Like, if you love the restaurant game, but you're not a businessman, but you love to be a chef, focus on being a chef. There's a Steve Ballmer, the owner of the Clippers. He was number 6 in Microsoft, right? And he said this all the time. He's like, every time I was the number 1 in the company, we lost money or we broke even. Every time I was number 5, 6, 7, 8, 9, 10, made millions. So know that about yourself, because if you're chasing an ego trip and you want this notoriety and you don't really care about what you're doing, then you're never going to be happy. But if you know, hey, what's my why? Why do I love to cook? Well, it makes me happy. I like bringing people together. I like seeing the experiences, whatever it is. Okay, now that's your why. Now, how far do you want to go with that? Do you like business? No, I don't, but my boy does. His boys are the perfect example. His boy Conrad Mayo Meals, he'll be on here next. Conrad's just a good chef. He doesn't know business, but his cousin knows business. Propel it together, Exactly. Understand it. Understand who you are. And like, for example, Teddy and I don't feel any ego when he takes over the full communication with the GC, even though that was my connect. I'm like, no, let him run with it. Like, it helps me. It's like, just be secure in yourself because of the value you provide, and know your role of how to make this ship float. Because if you're only worried about yours, then the coal is not going to start pumping anymore because you were too worried about, looking good and impressing people. It's like, you have to understand who you are and what your part of the role is. And if you like it more enough and you're passionate about it, you're not going to care about the notoriety, because the team is what's going to flourish and you're going to get to where you want to be. And it doesn't matter because you're happy every single day with the people you do it with.
Exactly. And I think one way to figure out what you really want to do in life is, like, ask yourself, okay, when I was really, really young and really, really little, what did I naturally gravitate towards? Did I like writing? Did I like reading? Did I like talking to people? Did I like numbers? Was I a science guy? Like, figure that out. Really take the time to ask yourself, and then I think that unlocks such a great thing in you, and you'll really put the puzzle pieces together.
Cool. I appreciate it, guys.
Awesome.
Thank you.
It's a pleasure.
Thank you so much, Alex.
Where can everybody find you?
We're on all of our socials are JP Acquisitions, but they're going to change to JT Acquisitions. So whatever it is, by the time I
think it'll be JT.
Yeah,
so.
by the time, yeah.
Exactly.
And then our individual platforms are connected as well, but we're plugging the company today.
Cool.
Yeah.
All right, thanks, guys.
Yeah, thank you.
Thanks, brother.